Making your first real money is the first step. Once you build capital, you have to defend it against legal threats and the algorithms that control modern financial markets. You've likely heard gurus promote concepts like Wyoming LLCs, dark pools, and infinite banking, presenting them as the exclusive mechanisms used to bypass public market friction. They claim these tools provide absolute legal invisibility from lawsuits, while allowing you to execute massive market trades with zero price slippage. Applying these strategies creates a difficult choice. Protecting your identity and navigating complex markets requires a careful balance to avoid crushing regulatory costs or sophisticated fraud. This chart evaluates these strategies by weighing the setup effort against the actual protection. Basic tools like index funds sit in the low-effort reliable zone, while institutional tools like dark pools require significant overhead. PPP scams fall completely into the fraud zone. Adopting billionaire-tier strategies before you have the necessary scale creates a burden of compliance and increases your exposure to predatory schemes. Effective wealth preservation relies on the philosophy of entity isolation. Own nothing, control everything. This represents standard domestic architecture. An irrevocable trust owns a Wyoming or Delaware holding LLC, which owns your operating assets. Removing your personal name creates a corporate veil, preventing personal creditors from reaching the capital inside. This protection requires thousands in setup fees, strict annual audits, and the legal transfer of your assets to a third-party structure. Large estates often use jurisdictional arbitrage, moving assets to locations like the Cook Islands or Nevis to take advantage of protective local statutes. These offshore trusts force creditors to hire foreign counsel and navigate an unfamiliar legal system with a statute of limitations as short as 1 year. Strategic asset protection engineers a legal pursuit so complex and expensive that predators look at the math and simply abandon the claim. Market predators operate through code. High-frequency algorithms can trigger sudden drops, bleeding your returns through price impact. On a lit exchange, large orders are public. If an institution places a $100 million order, the entire market sees that intention before the trade happens. High-frequency algorithms detect these orders in microseconds, buying shares ahead of the institution and selling them back at a higher price, causing immediate price slippage. To counter this, institutions use alternative trading systems, or dark pools. This matrix compares both. Dark pools remove pre-trade transparency, hiding massive blocks to prevent immediate market impact. However, since dark pools derive pricing from lit markets, predatory algorithms fire tiny pinging orders into the pool to sniff out this hidden liquidity. Using dark pools involves a specific trade-off. You swap the certainty of price slippage for the uncertainty of whether your order will ever execute. Authorities view hidden trading as a systemic risk. Regulators are actively tightening oversight on opaque market venues. Regulations like the double volume cap and Reg SCI, PPP scams. These schemes target retail investors who are looking for high-level leverage. These scams use consistent bait, promises of guaranteed arbitrage, zero-risk leverage through SBLC leasing, and requirements for upfront blocked funds. If you issue a standby letter of credit, the fraudsters use it as collateral for a cash loan and disappear. You remain legally liable for a debt you never spent. Legitimate private placement structures are strictly invitation only, reserved for institutions with over $100 million in liquid capital, and are never advertised on the internet. Accessing 0.0001% systemic leverage without institutional accreditation leads to identity theft and financial ruin. Institutional tools create unnecessary friction and cost when applied to retail-scale portfolios. This roadmap matches legal and trading structures to 3 distinct net worth brackets. At the beginner tier, under $500,000, focus entirely on broad index funds in standard tax-advantaged accounts. This remains the most mathematically sound path. Once you scale between 1 and 5 million, isolate your high-risk assets with a single Wyoming LLC. Use lit exchanges with strict limit orders to defend against algorithmic front-running. At $10 million and above, you can justify the cost of nested offshore trusts and algorithmic brokers that use randomized uncrossing to navigate dark pools. Managing wealth at scale is a highly disciplined, methodical, and often repetitive process that relies on long-term strategy rather than viral loopholes. Building systemic leverage requires legally isolated compounding that matches your true scale.